I want to start with a number that forced people inside the Federal Reserve to make a decision they never wanted to make in public. $17 billion. Not over a quarter, not over a year. Overnight, quietly injected through the Federal Reserve Bank of New York on Friday, December 26th, immediately after the Christmas holiday. While most of the world assumed markets were asleep, that number did not appear because of growth, expansion, or opportunity. It appeared because something inside the system broke, and it broke fast enough that delay was not an option. I'm going to be very clear with you from the start. This is not a theory. This is not a chart pattern. This is not a narrative crafted to sell you excitement. This is plumbing. This is settlement math. This is collateral stress showing up exactly where it always shows up first, in the repo market, when institutions cannot meet their obligations with available cash. When that happens, they don't negotiate. They don't spin. They post collateral or they die. On that same morning, silver was trading at $77.16. That price matters because it sits far beyond where risk models were built, far beyond where leverage assumptions remain survivable, and far beyond where short exposure can be absorbed without immediate cash transfer. The timing was not coincidence. The price moved first. The liquidity followed because it had to. The overnight reverse repo facility is not where healthy banks go to optimize balance sheets. It is where institutions go when interbank trust disappears. In normal conditions, banks lend to each other. They manage liquidity privately. Touching the Fed window is an admission that peers either cannot or will not extend credit. That is why it carries stigma inside the industry. On December 26th, that stigma was ignored because survival outranked reputation. Here is the mechanical reality. Futures exchanges mark positions every single day. Losses are not optional. They are not theoretical. When prices move against the position, the clearinghouse calculates exposure and demands cash. Not opinions. Not forecasts. Cash. If that cash is not delivered, positions are liquidated automatically. No meetings. No appeals. Silver futures represent 5,000 ounces per contract. That structure allows enormous leverage. It also creates extreme sensitivity. A $1 move equals $5,000 per contract. Multiply that by thousands of contracts, and a $5 move becomes catastrophic in hours. At $77, margin thresholds that were designed for volatility regimes of decades past simply fail. Inside those institutions, desks did what they always do first. They tried to source internal liquidity. They shuffled collateral. They delayed where they could. Then the margin calls hit with numbers that exceeded on-hand reserves. At that point, the only remaining option was to pledge treasuries and take overnight cash from the central bank. That is how $17 billion appears on a holiday Friday. This is where the story becomes real, not abstract. When price stress hits the metals complex, it does not stay isolated. Bullion desks are not standalone businesses. Their positions are entangled with interest rate swaps, currency hedges, and funding markets. A failure to meet a metals margin call can trigger cross-default clauses elsewhere. That is why the response was immediate. This was not about silver profits or losses. This was about preventing a chain reaction. Now look at what happened simultaneously on the delivery side. In December, 12,707 silver futures contracts stood for delivery on the CME. That is 63,535,000 ounces. 1 month, one exchange. During a holiday period when delivery demand is usually muted, that amount represents a meaningful percentage of annual global mine supply being demanded at once. Not traded, demanded. This is the shift that changes everything. Futures markets function smoothly when most participants roll or settle in cash. When buyers insist on metal, the system is forced to confront inventory reality. Registered inventory, the metal actually available for delivery, has been declining for months. Vaults such as those operated by JP Morgan and Asahi have already seen material drawdowns. You cannot deliver what you do not have. When delivery notices exceed readily available registered inventory, banks are forced into the spot market to source metal regardless of price. That buying is not discretionary. It is obligation-driven. And obligation-driven buying does not wait for pullback. It chases price. At the same time, something else changed that most people misread. The borrow fee on SLV fell sharply, dropping below 1%, and roughly 10 million shares became available to borrow. two casual observers that looked like pressure easing. In reality, it was capitulation. Borrow fees spike when short sellers are aggressive. They collapse when shorts leave. No one was willing to stand in front of a market that had just triggered a central bank liquidity response. The mechanics are simple. When short sellers close positions, they return borrowed shares. That increases supply in the lending pool. Fees fall because demand disappears. This is not bearish. It is retreat. The reflexive trade that suppressed silver for decades broke when risk became asymmetric to the downside for the shorts. This matters because it removes friction. In a normal market, rising prices attract sellers. Short sellers step in, fage momentum, and provide liquidity. When they vanish, price can move through levels without resistance. That is how you get air pockets. That is how $5 moves happen without pauses. Now step back and ask why the Federal Reserve chose to intervene immediately. They did not do it to protect the commodity price. They did it because the architecture of modern finance cannot tolerate uncontrolled leverage unwind. In 1980, silver nearly took down brokerage houses. In 2008, commodity collateral failures exposed deeper rot. The lesson was learned. When a leveraged node destabilizes, you either flood the system with liquidity or accept systemic failure. On December 26th, they chose liquidity. They always do. But here is the paradox they created. The problem they were responding to was currency dilution relative to hard assets. The solution they applied was to dilute currency further. Printing dollars does not create silver. It does not increase inventory. It does not reduce delivery demand. It simply raises the nominal price required to balance scarcity. This is why suppression fails under physical constraint. Paper markets can overwhelm price discovery only as long as margin is abundant and delivery is avoidable. When cash is scarce and delivery is demanded, leverage turns from weapon to liability. From the perspective of smart capital, this changes behavior. You do not short into a market where central banks are backstopping losses. You rotate, you move upstream. You seek exposure that benefits from currency debasement without counterparty risk. That is why miners move violently. That is why physical premiums widened. That is why delays appeared in sovereign coin supply. Now let me be precise about strategy. Not advice, but behavior. When markets enter this phase, the goal is not trading ticks. It is survival positioning. Physical assets outperform paper claims because settlement certainty matters more than quoted price. Timing, psychology shifts from optimization to availability. Risk is no longer volatility. Risk is absence. On the other side of this trade sit institutions trapped by their own structures. Banks cannot let price rise freely because losses explode. They cannot suppress price without liquidity because leverage requires margin. They cannot allow defaults without triggering contagion. Every path forces the same outcome, more currency creation. This is the enemy frame. Not personalities, but systems. Paper markets built on fractional reserves fail when enough participants demand conversion. Policy traps central banks into choosing inflation over collapse. Suppression mechanisms work until they don't, and when they break fast. We have seen this movie before. The London gold pool collapsed when physical demand overwhelmed coordinated selling. Price controls in the 1970s failed when inventories vanished. Every attempt to cap a strategic commodity without controlling supply ends the same way. A violent repricing that restores balance. Now, add geopolitics. When rivals see emergency liquidity operations tied to commodity stress, they do not back off. They press, they accumulate, they tighten supply chains. Financial weakness invites strategic pressure. The December liquidity injection was not just domestic signal. It was global. This is why the window matters. Scarcity does not announce itself politely. It reveals itself when markets stop functioning normally. When delivery demand spikes, when borrow fees collapse, when central banks step in quietly instead of speaking loudly. The closing logic is simple and uncomfortable. The window to reposition always closes faster than expected. When shelves empty, price becomes irrelevant. When delivery fails, paper decouples from reality. Wealth does not disappear in these moments. It moves from promises to possession, from leverage to substance. I am not interested in hype. I am interested in math. And the math says this system chose inflation as the release valve. That choice guarantees nominal repricing of scarce assets, not because anyone wants it, but because there is no alternative left. Pay attention to inventory. Pay attention to delivery. Pay attention to liquidity operations that appear on quiet days. Those are the signals that matter. This is not the end of volatility. It is the beginning of repricing. The people who survive these transitions are not the fastest traders. They are the ones who understand structure and act before structure fails. The system has shown its hand. The rest is just arithmetic catching up. That is where we are now. The decision has already been made. The consequences are simply waiting to arrive.